The stock market is on edge as the tech stocks face a sharp sell-off and investors grapple with uncertainty over Federal Reserve policies. Today on Talkpoint, we break down the causes of this volatility and what it means for the economy and your investments. So, stock charts showing recent declines, Nasdaq index dropping and headlines. In the past few weeks, major technology companies have experienced significant price drops, dragging down indexes like the Nasdaq by several percentage points. Investors are growing cautious and amid fears of slowing growth and rising interest rates. High-profile names in cloud computing, semiconductors, and AI have all been hit, fueling concerns of a broader market correction. Tech compasses, product launches, earning reporters. Tech stocks are particularly sensitive to changes in interest rates and investor sentiment because their valuations often rely on strong future earnings growth. When the Federal Reserve signals tighter monetary policy, raising rates or reducing bond purchase, borrowings costs rise and future profits become less valuable in present terms. This dynamic often triggers a sell-off in growth-oriented sectors like technology. Future speaking, Federal Reserve building interest rate graphs. The Federal Reserve has been navigating a delicate balance between controlling inflation and supporting economic growth. Recent comments from Fed officials suggest that rate hikes may continue or remain higher for longer than markets expected. This hawkish stance is intended to rein in persistent inflation but has raised alarms among investors about potential economic slowdown or even resilience risk. Traders on the floor, investor interviews, sentiment graphs. Investors are responding by reducing exposure to riskier assets, particularly high-growth tech stocks. Volatility index have spiked, indicating increased nervousness. Some fund managers are rotating into safer sectors like utilities and consumer staples. The mood is cautious as markets await clearer signals are on the Fed's next moves and economic data releases. Small business owners, consumer spending footage, manufacturing lines. The stock market turmoil reflects broader economic concerns. Higher borrowing costs can slow consumer spending, business investment, and hiring. If prolonged, this effect could dampen economic growth and weigh on corporate earnings across sectors. Consumers may also feel the pinch as credit card rates and mortgage costs rise. Financial analysts, economist interviews, expert panels. Market strategists suggest that while volatility may continue, the underlying economy shows resilience. Inflation trends, employment numbers, and corporate earnings reports over the next quarter will be critical in shaping the market's trajectory. Some experts advise investors to stay diversified and focus on long-term fundamentals and short-term swing. Economic calendar, market apps, portfolio management. Investors should closely monitor Federal Reserve announcement, inflation data, and earnings reports from major tech firms. Staying informed and maintaining a balanced portfolio can help navigate uncertainty. Using tools like stop-loss orders and regularly reviewing investment goals is also recommended. Stock market volatility can be unsettling, but knowledge is your best defense. For more insights and updates, stay tuned to Talkpoint. Please like, subscribe, and share your thoughts in the comments below.